America's car market is facing a crisis unlike anything we've seen before. For years, easy loans and cheap financing fueled a buying frenzy, sending car prices higher and higher. People who never could have afforded a brand new vehicle suddenly found themselves driving off dealer lots with SUVs and trucks that carried price tags of $50,000, $60,000, or more. Lenders were more than happy to hand out money, stretching payments over 6, 7, even 8 years. It all looked sustainable until now. Today, the cracks are impossible to ignore. More than $1.2 trillion in auto loans are currently outstanding in the United States, and a growing number of borrowers are falling behind. Delinquencies are spiking to levels not seen since the financial crisis of 2008. Millions of Americans are underwater on their vehicles, owing more than their cars are worth. And with interest rates climbing, monthly payments that already pushed families to the breaking point are becoming simply unpayable. This is not just a story about numbers. It's about households stretched to the limit, families forced to choose between paying for their car or paying for groceries. It's about young people crushed by loans they never should have taken in the first place, and retirees on fixed incomes watching their budgets collapse under the weight of rising bills. And here's the alarming part. This bubble was predictable. For years, experts warned that lenders were playing with fire, offering long-term loans on rapidly depreciating assets. Cars lose value the moment they leave the lot, but the loans attached to them can last nearly a decade. It was only a matter of time before the math stopped working. What we're seeing now is the early stage of a much larger storm. The auto loan bubble is swelling to the breaking point, and when it bursts, the fallout won't just hit borrowers. It could rattle the entire car industry and send shockwaves through the American economy. To understand today's auto loan crisis, we need to rewind the clock. After the 2008 financial crash, the Federal Reserve slashed interest rates to near zero. Credit became cheap, and lenders were desperate to move money back into the economy. For the auto industry, this was a lifeline. Dealerships and banks quickly realized that if they made loans easier to get and stretched them out over longer periods, Americans would keep buying cars, even if prices climbed higher than ever before. By the mid-2010s, a dangerous pattern had taken hold. Instead of the traditional 3- or 4-year car loan, lenders began offering 6- and 7-year terms. Some even went as far as 8 years. Monthly payments looked affordable on paper, but the reality was far more troubling. Borrowers were locked into massive debts on cars that lost value much faster than they could pay them off. Within months, millions of people were already upside down, owing more on their loan than their car was worth. Meanwhile, carmakers pushed prices into the stratosphere. Trucks and SUVs became the centerpiece of the American market, and their average price surged well beyond $50,000. Add rising technology costs, safety features, and the growing hype around electric vehicles, and suddenly even mid-tier cars were priced like luxury items. But instead of cooling demand, easy credit kept the machine running. Lenders packaged auto loans into complex securities, bundling good loans with risky ones, eerily similar to what happened in the housing market before the 2008 crash. Wall Street investors were eager buyers, chasing high yields without fully understanding the risks. It was the same playbook, just with cars instead of houses. For a while, everyone profited. Automakers posted record revenues. Banks raked in billions in interest payments. Dealers moved cars off their lots faster than ever. But underneath the surface, debt was piling up. And like every bubble in history, it was only a matter of time before reality caught up. Today, that moment has arrived. Rising interest rates, falling used car values, and a wave of missed payments are exposing just how fragile the system really is. The warning signs are no longer subtle, they're flashing red. In the last 18 months, the cost of borrowing has skyrocketed. Interest rates on new car loans have doubled, pushing average monthly payments past $750 for new vehicles and $550 for used cars. For many families, that's the equivalent of a second rent payment. At the same time, used car values are collapsing. During the pandemic, supply shortages caused used car prices to surge to record highs. Buyers who paid $30,000 for a used truck in 2021 are now discovering it's worth closer to $20,000 today. But their loan balance hasn't gone down. It's still $28,000, $29,000 or more. This means millions of Americans are deep underwater, trapped in loans they can't escape. Repossession rates are climbing rapidly. Lenders are seizing cars at the fastest pace in over a decade. And it's not just subprime borrowers this time. Middle-class families with good credit scores are falling behind. Even households with 2 incomes are struggling to keep up with payments as food, rent, and utility bills continue to rise. The auto industry itself is beginning to feel the squeeze. Dealerships are sitting on lots of unsold inventory. Automakers who banked on endless demand are now cutting production schedules. And banks are quietly tightening their lending standards, making it harder for anyone to qualify for a loan. This creates a vicious cycle. Fewer buyers, falling car values, and rising defaults. Experts are calling it the perfect storm for the car market. A $1.2 trillion debt bubble is colliding with economic headwinds, high inflation, stagnant wages, and a weakening job market. And unlike the housing market, cars don't hold their value. They depreciate fast, which means there's no asset to fall back on when things go wrong. We are now at the breaking point. What began as a slow drip of missed payments is turning into a flood. And the consequences won't just hit borrowers. They could shake the entire auto industry to its core. The collapse of the auto loan bubble isn't just a personal crisis for borrowers. It's a systemic threat that could ripple through the entire economy. At the most basic level, millions of Americans losing their cars means millions of people losing their ability to get to work. In the United States, a car isn't a luxury, it's survival. Unlike in many other countries, public transportation often isn't a viable option. Without a vehicle, households risk losing their jobs, their income, and their stability. For the auto industry, the fallout could be catastrophic. Automakers depend on a steady flow of buyers, and if demand collapses, factories will be forced to cut back production. That means layoffs, potentially tens of thousands of workers losing their jobs across assembly plants, supplier networks, and dealerships. Entire towns that depend on auto manufacturing could face economic devastation. Banks and investors aren't safe either. Remember those bundled auto loan securities? As defaults rise, the value of those investments plummets. Pension funds, hedge funds, and major financial institutions are all exposed. While this isn't on the same scale as the 2008 housing collapse, the parallels are alarming. Once again, Wall Street is discovering that chasing high returns without understanding the risks comes at a heavy price. Then there's the used car market. As repossessed vehicles flood auctions, prices will fall even further, trapping more borrowers underwater and triggering yet another wave of defaults. It's a downward spiral that's hard to stop once it begins. On a larger scale, the crisis threatens consumer spending. When households are drowning in car debt, they cut back on everything else: restaurants, vacations, shopping. This ripples out into the broader economy, slowing growth at a time when inflation and rising costs are already squeezing families. The auto loan bubble is no longer just an industry story, it's becoming a national economic problem. And if policymakers, lenders, and automakers don't act fast, the fallout could define the next financial downturn in America. The question now is simple: where does this all lead? The car loan collapse is already underway, but the full impact will unfold over the coming months and years. For consumers, the short-term outlook is painful. Repossessions are set to climb higher, meaning more families will lose their vehicles. Credit scores will take hits, making it harder for people to borrow in the future. And with stricter lending standards, millions of Americans may find themselves locked out of the car market entirely. Automakers face a crossroads. Some will push aggressively into electric vehicles, hoping government incentives and fresh demand can keep production lines running. Others may cut back, closing plants and shedding jobs just to survive. Either way, the industry is about to undergo one of its most turbulent periods in decades. Banks and lenders will try to protect themselves, but history suggests they'll be caught off guard. If defaults rise too sharply, we could see smaller regional banks collapse under the strain, similar to what happened with housing in 2008. Larger institutions will survive, but at the cost of tightening credit even further. Policymakers may be forced to intervene. That could mean government-backed bailouts for automakers, subsidies for buyers, or even federal programs to ease loan burdens. But every one of those solutions comes with controversy, especially as public frustration grows over the cost of living. And then there's the bigger picture: confidence. The auto market has long been seen as a cornerstone of the American economy. If people start believing that owning a car is out of reach, it reshapes not only consumer spending but the very culture of mobility in the United States. The truth is, no one knows exactly how bad the collapse will get. But one thing is certain: the $1.2 trillion car loan bubble is bursting. And when it does, it won't just take down cars and credit, it could shake the foundation of the American middle class.